Good afternoon and welcome to this session on investing your pension ethically as part of Pensions Awareness Week. My name is Rafe Benson. I'm founder of MoneyCube and I'm joined this afternoon by Sarah Norris, who's manager of the Global Equity Impact Fund at Aberdeen. Hi Sarah, how are you today?
Hi, very well, thank you. Thank you for having me.
Great, thanks for joining. I guess I've been quite excited to have this session because I think, probably 2020 and 2021 have been the years in which, if you like, ESG investing has come of age and finally started to get the attention it deserves. But maybe we could start by hearing from the horse's mouth, as it were, what ESG means to you, what it stands for a start, and how you came to it.
Definitely. So ESG is the shorthand for environmental, social, and governance investing. And increasingly, we're seeing all funds, all asset managers talking about integrating ESG into their investment approach. And that is because there's a growing recognition that environmental, social, and governance issues at a business will have serious financial repercussions to that business's profitability or to the multiple that the business trades on in the stock market. And that growing awareness has made ESG a more popular way to analyze companies. And apart from just ESG integration into the investment process, which you see at most firms, you're now also seeing ESG outcomes. And what I mean by ESG outcomes are specific products and specific targets around environmental, social, and governance characteristics. That can be your typical ethical investment, where that's normally exclusion-based, and the ethical portfolio construction is around avoiding sectors like alcohol, tobacco, armaments, animal testing. Then you also have sustainable and responsible investing, where you're focused on how is a business running itself, and you're looking for businesses that are managing those ESG risks better than their peers. So they have better employment programs, better environmental policies. And then more recently, we've seen an increase in impact investing, which is what I'm actively involved in. And that is allocating capital to companies whose products and services are solving some of the world's problems. So you can see that slow evolution from just exclusion to focusing on those risks and opportunities, and if there's a mispricing opportunity, and ultimately then to what are those products and services and how are they transforming our world. And I'm involved in impact investing because my background is actually non-traditional. I have been working at Aberdeen for the last 10 years, but before that, I worked more with development organizations, specifically focused on Africa and education programs. So my background is not finance at all. I've definitely picked up those skills, but my passion was on the development side of things, and impact investing as a way to marry those two.
Yeah. Okay. Yeah. I mean, way I sometimes tell to people is that it's almost a continuum, and if that's right, I guess, you are definitely at the sharp end of, of like really asking the hard questions that I suppose is almost filtering down. You're at the leading edge of that whole understanding, I guess, and filtering down to how other fund managers are looking at it now and only beginning to introduce some of those ethical criteria to how they evaluate their investment choices. So,
definitely. It's a spectrum of capital. There's no right or wrong way, but it's just layers. I think of it as kind of a cake, and you slowly layer on to get to that impact side of things versus kind of that baseline exclusions and ethical. And it just depends on your preferences as an investor and what aligns with your belief system and how you think about the risks associated with different types of strategies.
Yeah, like I think the question I've always thought, when we say ethical as opposed to ESG is like, well, that's great, but whose ethics? And I think certainly in the Irish market, and I'm conscious, you have a global perspective sitting in, I was going to say sitting in Aberdeen in Edinburgh, but from an Irish perspective, where the choice has historically been quite limited in terms of ethical investment options. But I do wonder, is that what you think we will start to see? Is more choice to align fund strategies with one's personal ethics? Is that coming into the market?
I think yes and no. I think yes, on the one hand, in that you'll have more products that you can choose from. I certainly think that there's a big push to have more ESG products. So not just have that ESG integration into analysis, but thinking about those different outcomes. And you're starting to see more thematic products, so focused only maybe on environmental concerns, only on social concerns. But when it comes to impact investing, I always tell my clients, it's not about your morals, it's not about your ethics, because everybody's morals and ethics are so very different. So when you're buying an impact product specifically, you're not going to have a say on what are the most pressing problems once you're invested. So with an ethical fund, we send out a survey to all our clients. We ask them about their morals and persuasions, and we build our universe based on their views. With impact investing and the global fund, we define the world's most pressing problems using the United Nations definition of where they see the greatest need, and that's their 2030 agenda and the Sustainable Development Goals at the moment. And so, for example, within ethical investing, we'll exclude companies that test on animals. Within the impact fund, we don't. So I think as an investor, you have to be conscious that there will be different mandates, and hopefully you have more choice to align, but you're not going to have a say in the direction of each of those mandates, if that makes sense.
Sure. Yeah, no, I think it does. And that's interesting, because I suppose that probably disrupts my neat idea of it being a continuum, because, arguably then at the impact end, if you are not excluding those animal testing investment opportunities, that could be controversial to some investors' minds.
It might be, yeah. And then I'd say there's an ethical range that is probably more suited to you if you want to have a say in what we invest in. Or I guess ethical investing, you get a say in what we don't invest in. And you help us pick what we don't invest in. With impact investing, you don't get a say at all the way we've set it up, but you can have confidence that we're aligned with the UN. And so if you believe that is our kind of international guidance or standards on where we should allocate capital, what are the most pressing global problems, then you can take confidence that is the direction of travel. So I guess it just depends on how you, as the client, are thinking about ethical investing. And it's frustrating is that we throw so much jargon at investors and we say ESG, SRI, impact, ethical, what does it all mean? And unfortunately, you can't just look at the labels on funds, you have to read what is the objective.
Absolutely. And certainly if you were to look at the labels on funds, so many more have that label now, and it's very easy to change your name, right? So but changing what's under the bonnet takes a bit more time and thought, I suppose. So yeah, I'd certainly agree with that. I guess, like so just looking at your portfolio then in the impact fund more specifically, like it's quite a concentrated portfolio, around 40 stocks in the equity sort of 40 separate stocks held. So my question would be, like, how do you see that fitting with a wider portfolio? Is it possible to have a kind of balanced portfolio which is pure ESG, would you say, or pure impact? Or how does that fit with a wider portfolio?
Yeah, I think with sustainable investing overall, so all types of kind of outcomes, there is a natural bias to higher quality companies because these businesses are managing their risks better, and they're capitalizing on opportunities. So having that quality bias within the portfolios is probably something that you'll see within most sustainable portfolios, and that tilt. Within the impact strategy specifically, because we're looking for companies that have a material exposure to one of our 8 themes, and we've got 4 environmental and 4 social, it's harder for a large business to be able to spend the amount of money that we want to see on a one product or service. So the bigger the organization, the harder it is for the product or service we're focused on to being material to that business. So we do have a natural gravitation towards more mid-cap names. So you do see that bias. And we also have a bias away from maybe some of the more popular sectors in the market. So it does provide a nice counterbalance. I mean, we don't invest in any of the FANG stocks, so Facebook, Apple, Netflix, Google, because if you think about those business models, and for us, we're very much focused on how is a company investing to change the world, and is that change in the world good? Is it aligned with the UN? it's hard to argue that Facebook, Apple, Netflix, Google are solving any one of the world's most pressing problems, and that's core to why they exist. So
they're the incumbent, if you like.
Yeah, they're not disruptors. So our global fund does have slight tilts, and I think sustainable investing overall has slight tilts, but in my opinion, that's where the market is going.
Yeah.
I think the market is moving away from those dirty sectors or sin sectors, to use the ethical terminology, not necessarily because they're bad. I think that's a relative term, but because that's not the focus of regulation. If you think about the Irish government is saying, what governments in the EU, what the UK is saying around climate change, carbon targets, traditional energy companies are not going to look the same in 20 years. There is going to be a much larger skew towards renewable energy, for example, and that naturally transitions you away from certain sectors and also biases portfolios away from certain sectors. So I think we're in a fascinating point in the market where the entire industry is undergoing an overhaul.
Yeah, no, I think that's right. And it's not yet all priced in, like I don't think, say, big oil has particularly had the risk around stranded assets, great to have discovered lots of reserves under the Arctic. Will you ever pump that? Who knows? But pretty difficult to kind of A, do, and B, represent that value in the share price and kind of price up that risk accordingly. So there's definitely kind of, I think one of the things that the ethical investing movement has done is kind of shone a spotlight on some of the risks around kind of old style portfolio, as well as the opportunities of an ethical one. And it's probably a good point to note, like your fund is up kind of knocking on for 14% annually over the last 3 years, and 30% over the last 12 months, right? So
we've done all right.
Strong, right? So yeah, no,
we've done all right. We've done it. I mean, I think that comes back to the fact, I always call it kind of the twin forces. And you and I, we know where our food comes from. We're more conscious of what we're eating. We're conscious of how we're shopping, and those consumer awarenesses and shifts is also guiding that public policy that's shifting towards being greener and being fairer. So it's the businesses that are positioned to manage that transition the best and manage those risks and also capitalize on that opportunity that are going to be the ones that deliver the most sustainable outperformance. So we own a business in the US that's focused on renewable energy generation. They're the largest renewable company globally, a company called Nextera. And for them, they've built such a market position that it's cheaper for them to buy up old coal-fired power stations, shut them down, and build renewable energy facilities and sites. And that's helping keep up with the demand in the US, because the US has phenomenal demand and it really lacks supply. And so they had enough foresight to be able to position and maneuver the business in that direction. And it's that kind of business that we're looking for.
Yeah. Okay. Well, that kind of leads on to a bit that I was really just interested to discuss generally, which is, how do you go about evaluating a stock for your fund? What rate do you introduce new stocks? How many ideas might you have at one time? Those kinds of questions. I'd be really interested to understand how you're managing the fund from that perspective.
Yeah. I think the first thing to say is that with impact investing, you can't screen for impact. So you can't use MSCI or other data providers. You really have to have fundamental bottom-up analysis. So we meet our companies a couple times a year. We're very focused on what is their strategy and how does it align with the UN's overarching agenda. So rather than just a revenue screen, which can be misleading, we're focusing on how are companies positioning themselves now and what are they going to look like in the future. And can we also get to a point where we can measure that impact? Because impact investing has a double bottom line objective, is what we call it, the outperformance, which our fund has delivered very strongly, as well as that impact measurement. And we produce an annual report with all the stories of the companies that we've invested in. And we're looking for, as I said, alignment to four environmental themes and 4 social themes. And for us, once a company has kind of met our thresholds for impact, and we've decided, yes, the strategy aligns, and we can see the business direction, and we expect them to begin to report on the impact their products and services are having, we focus more on the financial case, and because we do have that outperformance objective. So when we introduce a name, it's based on confidence around the financial outperformance, and we tend to have very low turnover. We want to hold a business. So if we build enough conviction in a name, both from a financial point of view and the impact case, we tend to hold for multiple years. And so at the moment, we have a very low turnover rate. It's sub 15%. But we're always looking for new and innovative businesses. One company that we've been doing a lot of work on is a company called Insulet. And they do insulin delivery systems, but they are pods that just go on your shoulder, that don't have any tubes or wires. And what makes that so unique is those insulin delivery systems are connected with your iPhone. So if you're a child with diabetes, your parents can monitor your glucose levels and then be able to distribute the insulin when it's needed. So it's a real disruptive business model that's changing how we care for diabetes. And diabetes is one of the most pressing non-communicable diseases that we have identified globally, and it's only increasing in its prevalence. So for us, that's that's the type of business that we're looking for, something that is disruptive. It's taking advantage of a problem. That's maybe the wrong terminology. Sees a problem and has identified a solution, and that solution therefore will deliver those sustainable returns, both from an impact perspective and from a financial perspective.
Yeah. Okay. And you might walk the road with that company for like 7-8 years. Yeah. Okay. Interesting. And how do you measure that impact? You mentioned, there is no index we can turn to.
No, unfortunately.
I mean, but I guess you've got to put some rigor around that. How do you think about impact?
So the framework that we developed, we've identified these 8 themes using the 17 Sustainable Development Goals. And when we think about measuring the impact in each of these 8 themes, we've also looked at the key performance indicators that the UN set for the Sustainable Development Goals. And while those are for countries, we're able to aggregate them and identify 5 or 6 main indicators per pillar that we want a company to be able to report on. So for healthcare, it's around patients, it's around driving down costs. For financial inclusion, it's individuals with basic financial services, it's financial literacy programs, it's SME lending, so small and medium-sized business lending, insurance coverage. For some of the environmental focused around water and sanitation, it's volume of water cleaned, energy around carbon or cleaner energy emitted. In the circular economy, which is all about reducing consumption and improving reuse and recovery, that's around material and volumes. So we've got multiple KPIs for each of the different pillars, and hopefully at least one will align. Well, not just hopefully. When we're doing the analysis, we make sure that at least one of the indicators that we've identified will align with the company's business model and how they're investing in those products that they're developing.
Yeah. Okay. Yeah. And it sounds like, I suppose what's interesting about the fund is it isn't, a lot of the options that are coming out there are very focused on, I don't know, it's a solar fund or whatever it is very specific kind of industry or opportunity. Whereas here, actually, a very broad perspective across from whether it be human health to financial inclusion to, sustainability and climate issues or whatever. So
no, we developed that intentionally, and I think it comes back to your question around maybe some of the biases in sustainable portfolios. And I think if you have only a climate portfolio, that naturally leads you into certain sectors, and that naturally leads you to certain risk characteristics and maybe tilts into certain industries and doesn't necessarily always give you the best diversification opportunity. Whereas when we built the global impact strategy, we knew we wanted to compete with your core holding, your core pension fund, to build a portfolio that doesn't have risk characteristics that are off the charts, that is attractive to a retail investor. And to do that, we think we have those 4 environmental and 4 social, and that gives us also a balance of traditional industries. So we have healthcare, we have industrials, we have financials, utilities. Where we're underweight is maybe that it comes back to that sustainability point. We don't have alcohol or tobacco, mining, extractive industries, and that's probably what you'd expect. But the tilts in the portfolio aren't too different from a sustainable portfolio, which is something we were very conscious of.
Yeah, because like on a just even on a superficial level, if someone someone was asked, "Oh, would you like your investments to be sustainable? Like it would be extraordinary if you didn't, right?" No,
Yeah,
I
yeah.
want all my investments to go up and smoke in 12 months. Nobody wants that. So, I almost think like everyone
Why
wants it
wouldn't you?
sustainable. Yeah, yeah,
Yeah.
in one sense or another. So, like, if we look to the future, then a little bit, how do you see this whole ESG game evolving? You've mentioned that, like, I suppose there's a bit of a like almost a Betamax VHS situation with SRI versus ESG and whatnot, and actually no real, certainly at the kind of investor level as opposed to the professional level, it's not quite the Wild West, but it's
It is a bit.
yeah. So it's a best opaque kind of forming a view on that at the retail level. But how do you think that's all squaring, going to unfold over the next, say, 2-3 years, now that we've got a bit of a tailwind for ethical
I
investment?
think we'll definitely be seeing more funds, more opportunities for investors to choose between different strategies. And the regulator is not ignoring that. And I think we are seeing tighter regulation around definitions. I mean, we've already seen the European Union's taxonomy and how they define climate change and climate solutions. And I know there were a couple people from Ireland that were actually sat on the task force for developing that. So Ireland has had a very loud voice in how we define sustainability and certainly the climate focus. And I think that's only going to continue. There's now a task force working on how we define biodiversity. And so as we see more regulation, that then hopefully means in 2-3 years, you could look at the label on a fund and it will make more sense versus right now, the definitions are different depending on what firm you go to. So I hope we're making it easier for clients to adopt an ESG strategy or an ethical strategy, not harder, both from a choice point of view and also more homogenization in terms of how we think about labels.
Mm-hmm, mm-hmm. Yeah. And do you think, I mean, is there a scenario where it almost becomes so ubiquitous that one, being an ethical investor won't, at the moment, that's a kind of almost has to be a conscious decision. I mean, you can avoid the worst of it, the defense assets and whatnot, but like, is there a scenario where it almost becomes, the opt out will be for, no, I actively want to be in those sin funds and whatnot. Is that
I No, because I think there's that spectrum of capital. And if you're thinking about some of those sinful industries, maybe there are a few that we will move away from. But if you think about just simply doing no harm, you can think about a business model and how a business model does no harm. So I think there will always be a pocket of funds that simply integrate ESG analysis and do that bare minimum of no material harm. But I do think that the bulk of assets is shifting towards more sustainable mandates, simply because that's where the returns are to be generated. If the way I characterize it is certainly with impact, if we think about the world's most pressing problems, that creates phenomenal unmet need, whether it's need for environmental solutions, healthcare problems, financial solutions, and that unmet need is unmet demand. And for a company tapping into that unmet demand, you would expect to see much more sustainable returns in both meanings of the word sustainable. So I think the pivot towards sustainable outcomes is a strategic shift in the industry rather than a trend or a flash in the pan.
Yeah, yeah. Okay, I think we'll probably leave it there. Like that's just been a really useful and interesting discussion around, I suppose, that spectrum of stuff that's there, and I suppose, if we think of your fund as somewhere at the cutting edge of that and thinking harder about these questions than purely excluding things, I hope it's given our viewers a real sense of both what's out there, but also what's in the pipeline, and we're likely to see uh, over the next wee while. And I suppose what's exciting about it is, as you say, the extent of the opportunity, and I guess that almost somebody who's thinking about these questions is getting in ahead of the rest of the pack and what that means in terms of potential investment returns as well. So thank you for joining today, Sarah. Really appreciate your time on the line from Edinburgh. And thanks also for watching. There's loads more information available on the pensionsawarenessweek.ie website, and look to hope to welcome you there and see you at some of the other sessions. All the best. Bye bye.
Bye. Thank you for having me.